So people, now we are going to do a theory which is known as the Cambridge approach. Previously we did, just before this, we did classical approach, that is the version of Irving Fisher, that is known as quantity theory of money, QTM. What was the equation of exchange? MV equals to PT was the first version. Extended version, MV plus M dash V dash is equals to PT. What is M dash V dash? The credit money. M dash V dash is the supply of credit money in the market. Are we clear? Alright. Chale. And what was the name of the approach? Transaction approach, exactly. That equation was representing which approach? Transaction approach. Clear hai? Alright. So people, now we are moving towards the Cambridge approach, which is developed by Alfred Marshall and A.C. Pigou. Okay, very important approach to understand. It is nothing but the new version of the QTM, you can say. You will understand it right now. Okay, so this particular approach focuses on what thing? It focuses on the relationship between money demand and income, emphasizing the role of money in facilitating
transaction.
QTM was relating what? QTM was relating money demand with price. Money demand with
Price.
and classical approach is relating money demand with. You remember 4 factors
Yes, sir.
affecting money demand: income, price, rate of interest, and financial innovations. Price ho gaya in the classical approach. Now it is income. Are you clear? Sure. It is also known as cash balance approach, or I told you that was classical. This is neoclassical. I hope all of you understand what is neoclassical. Yes? The most important thing in this theory, the Cambridge version holds that money increases utility in the following 2 ways. First, enabling the possibility of a split up of sale and purchase of 2 different points of time rather than being simultaneous, that is transaction approach. Second, being a hedge against uncertainty, that is store of wealth. The language is bit typical. थोड़ा सा typical language है भाई. Right?
Yes.
Suni. It says it enables money increases utility in the following 2 ways. Why we increase the demand for money? Because first, it enables the possibility of split up of sale and purchase to 2 different points of time rather than being simultaneous, that is transaction motive. Shall I make it simple for you? Right? With money, you can do 2 things. With money, you can do 2 things. What? First, transaction, and second, saving. You're storing the wealth. First is transaction, second is saving. Are we clear? That is the easiest possible thing to understand. Clear hai itna? While the first above represents transaction motive, just as Fisher envisaged, the second points to money's role as a temporary store of wealth. क्या बोला मैंने आपको? First is the transaction approach. Guys, look at me now. First is the transaction approach, same as Fisher said. MV plus M dash V dash is equals to PT. Equation of exchange. Transaction motive. And second is Alfred Marshall and Pigou said they added one more thing to the approach. In the transaction approach, what they said? They said that money can be used to store the wealth. Store the wealth, which will act as 2 things to you. What? First, it will generate return if you invest it. Otherwise, you can save it so that any precaution you want to take for future, guys, precautionary motive. You can save money so that you can be very much ready for any uncertainty in the future. Are we clear, beta? Sure? Since sale and purchase of commodities by individuals do not take place simultaneously, they need a temporary adobe of purchasing power as a hedge against uncertainty. As such, demand for money also involves a precautionary motive in the Cambridge approach. Since money gives utility in its store of wealth and precautionary modes, one can say that money is demanded for itself. What these 2 points are saying? These 2 points are saying that you demand money for again two things. One, to conduct the transaction whenever you want to purchase the things and whenever you want to sell the things, that is the transaction. And second is to store the wealth so that you have money ready with you to deal with any future uncertainty. That is it. Fisher focused on transaction motives. Marshall and Pigou, they are focusing on transactionary and precautionary motives. Clear? Is this clear? That is it.
Sir, precautionary motive like a saving.
Yes, of course, like saving. Yes, of course, like saving. Are we clear? Okay, cool. So, we have studied Irving Fisher ka QTM, quantity theory of money. We have studied classical approach given by Alfred Marshall and A.C. Pigou, the Cambridge approach. We are now studying the one of the most important theories in the money demand, right? That is the Keynesian theory of demand for money, propounded by one of the very famous scholar, J.M. Keynes, John Maynard Keynes. Clear hai? Keynes ka theory of demand is also known as LPT, liquidity preference theory. Liquidity preference theory. Sir, what is liquidity preference theory? Look at me, this theory will tell you we prefer to hold liquidity. So what is liquidity? Cash. Liquidity preference theory. People prefer to hold cash. Or let us say people prefer to hold money in liquid form. Yes? Yes?
Yes, sir.
चल आगे. Let us see क्या बोल रही है. It's saying liquidity preference, a term that was coined by John Maynard Keynes, his full name, in his masterpiece, one of the most renowned books, that is the General Theory of Employment, Interest and Money, 1936, and denotes people's desire to hold money rather than securities or long-term interest-bearing investment. This thing we have already been studying. पहले से पढ़ रहे हैं हम. What I told you? I told you people love to hold cash in their pocket rather than investment.
Yes.
They will do the investment only when, guys, they will do the investment only when they feel, they see, they experience, they get to know that the opportunity cost of holding money is increasing. And the money and the point they see that the opportunity cost is increasing, then what they do? They take out their money and do the investment. Are we clear?
Yes.
Prima facie, generally the things are, this theory is saying that people like to hold cash rather than doing the investment in the securities for long term. Are we clear? Are we clear?
Yes, sir. Sir, this is something about rate of interest.
क्या हुआ?
Before sector rate था.
Yes, of course. Your question is, are they talking about the rate of interest? Yes, of course they are talking about the rate of interest. This is saying that long-term interest में people are not willing to invest long-term. Why? Because if they invest their money in long-term, they know that if they need money, they will not be able to realize money from the asset in which they have invested for the long term. Yes or no? Yes or no? So what they do, Keynes says that people either like to hold money in cash, or if they are investing in such a way that it is a very short term, so that whenever they need money, they can quickly liquidize their money, so that they can quickly convert that investment into cash and use that money to satisfy their basic needs. And are we clear? Please pay attention. It is specifically talking about long term interest bearing investment. Short term के बारे में कहीं नहीं बोला गया. Are we clear? Sure. Confirm motives of demanding money. It is a part of the Keynes theory. Why do we demand money? The question is why? Why do we demand money? The three motives of demanding money: transactions motive, precautionary motive, and speculative. Transaction motive says to buy goods and services, to do the transactions. Are you clear? To buy the goods and services or to do the transactions. Precautionary motive: to save, to take precaution for the future. In present, we are planning what to do, how to do, by whom it is to be done. The other management planning. We are planning here basically, right? Precautions we are taking so that we don't face any problem in the future. The third motive is the speculative motive, that turns out to be the investment motive. Like when you invest money, why you invest money? To earn more money from the money you have. Are you clear? Yes?
Yes, sir.
Transaction motive can be understood with this equation also, what Keynes gave. LR equals to KY. What is LR and what is KY? LR says transaction demand for money. Arey, how much money you need for transaction? How will you get to know? How much money you need for transaction? How will you get to know? We calculate it by KY. What is K? Ratio of earning kept for transactions purpose, and Y is earning. Please hold on for a minute and try to recall MPC.
Yes, sir. Yes. There's zero.
Marginal propensity to consume. What is it? Sir, how much additional consumption we will do from additional income? Can we say that how much additional money we will keep aside from the additional income for the consumption purpose? Can we say this? Yes or no? That is what is written here. What is K? Ratio of earning, propensity of earning, ratio of earning kept for transaction purpose, kept for the purpose of buying goods and services so that we can ultimately consume them. Yes or no?
Yes, sir.
Right? Ratio of what will you keep aside? Ratio of your earnings you will keep aside. So how much money you need for transaction equals to what? Your need equals to what? What you have. What is demand? Sir, willingness to purchase and power to purchase. Yes or no?
Yes, sir.
LR, which says transaction demand for money, is your willingness to purchase. How much you want to buy, how much transactions you want to do, how much money you need for transactions. Yes or no? Yes. And KY means how much money you have with you, how much money you have kept aside with you. This is the willingness to purchase. This is the power to purchase. You equalize them, that becomes your demand. Demand, that is transaction motive. Yes or no?
Yes, yes.
Are we sure with this equation?
Yes, sir.
Sorry? हाँ बिल्कुल ना. LR क्या है? How much money you need for transaction? That is LR. Willingness to buy. Willingness to buy can never be your demand alone, unless until it is supported by the money you have. So your willingness will become your demand for transaction when your willingness will be equal to what? Your power to purchase. What is your power to purchase? How much money you have in your pocket to buy the goods. How will you get to know about it? K, that is the ratio, percentage. What percentage of your income you are keeping aside for transaction purpose, for consumption purpose, for buying purpose, right? Into, this is the ratio means percentage of what? Percentage of your earning. So this is your willingness to purchase, this is your power to purchase, and collectively it becomes your demand. That is your transaction motive. Are we clear, everyone? Sure. APS, we are not talking about saving, beta. We're talking about consumption only. This is MPC. No, it is MPC. We talk about additional consumption out of additional income. If you want to relate with the APC, you may do so that also, because what you are thinking is it is the total income and total consumption. That also you can do. Chalega. But overall long term, if we talk about MPC only, we don't talk about APC. You will understand that. In long term, we talk about MPC. We work on marginal. We don't work on the averages. Marginal shows exact change in income. Average shows like in a period of time what was my average income. So we don't work on period of time, we work on the point of time. Okay, are we done? Oh, fantastic. But with this, actually this I kept this particular slide empty to explain the things. Anyways, I have explained you verbally. There is no need to write anything here, right? Concept of liquidity trap. देखिए बेटा, what is concept of liquidity trap? Before we understand that, right? Before we do that, I want to ask you people, do you have any idea how many types of banks are there in India?
Two types of.
Name them.
Central and commercial.
Central bank and
Commercial.
perfect. So guys, this is the post-Keynesian development in the theory of demand for money, where these are the three approaches which were developed after the Keynes ka theory. First is the inventory approach to transaction balances. Second is the Friedman's restatement of the quantity theory. The third is demand for money as behavior towards risk. The first theory we are going to study is about the inventory approach of transaction balances, which was given by Baumol and Tobin, right? This is also known as the inventory theoretic approach. Okay? Read it once. I will show you the working, how it works. Dikhata hu, right? Under this approach, money or real cash was essentially viewed as an inventory held for the transaction purpose. This approach says that the money or cash we hold, what is the main purpose of holding money? Is to do the transactions, right? Third point says the inventory models assume that there are two mediums for storing value. Means inventory means when you stock something. So when you save money, you do save money, you store the value of money in two mediums, two ways, right? Like if I'm earning money, I'm keeping money with me. So according to Baumol and Tobin, how will I use that money? I will use that money to store the value in two ways. First, I'll keep money with me, the cash. And the second is, I will keep the money in an interest bearing alternative financial asset. Means I will invest my money in an asset which generates interest for me, which generates return for me. That next says, we are assuming that there is fixed cost of making transfers between money and alternative assets, example brokerage. Means whenever you have money and you convert your money into an asset, I mean you try to buy the asset with your money, every time you buy the asset with your money to store the value, you have to pay a brokerage. Means brokerage is the commission paid to the broker for acting for you. I mean, when you will buy the security through a broker, broker is working for you. So for his work, for his service, he will charge a brokerage. Are we clear? So we are assuming that a fixed cost you have to bear every time you will convert your money into an interest bearing alternative financial asset. Are we clear? Yes or no? It means every time I will use money to buy the asset, I will pay brokerage. Clear hai? As per Baumol, people hold an optimum combination of bonds and cash balances, that is an amount that minimizes opportunity cost. I mean, Baumol said that what people do, people will not only hold cash, they hold, whenever they have money with them, what they do is some part they will keep as cash, and second, the other part they will buy asset. Okay, now on what basis, how will they decide that how much part they should keep in cash and how much part they should keep in an asset? That we will understand. Are you clear? Let us say I have 1 lakh rupees with me. Okay, there are two ways I can use this money. First, if I keep only cash with me, what will happen? It means there will be an opportunity cost. Yes or no? What will be the opportunity cost of holding cash with me? The interest, the return I can generate from the asset. Yes or no? बात किया था ना rate of interest में. I told you, if you keep cash with you, it means you are losing the interest what you could have generated. Yes or no? Let us say that the rate of return is 10%. Okay, so if I keep 1 lakh rupees with me in cash, how much money I am losing? My opportunity cost will be 10% of 1 lakh, that is 10,000. Correct? Yes or no?
Yes, sir.
According to Baumol, what do? We not only keep cash, we keep cash and investment both. Correct? How do we decide it? The second option is cash and investment. I will look on to my consumption expenditure. Means how much money out of 1 lakh I have to consume. Let us say I get to know that I need only 80,000 rupees for my consumption. Correct? Yes or no?
Yes.
It means I have how much money idle? 20,000 of money will be idle for me. Correct?
Yes, sir.
Yes or no?
Yes, sir.
Sorry, one thing we have done wrong here. The opportunity cost will not be 10,000, because if I say that out of 1 lakh, if I need 80,000 rupees for my consumption, it means if I keep cash with me, still I will consume 80,000 rupees. How much money will be idle? 20,000. Yes or no? So if I keep that 20,000 rupees idle, how much money I am losing? 2,000 rupees. Yes or no? Baumol said that what you can do is you can keep money, this 1 lakh, in a combination of cash and investment. Correct? 80,000 rupees you need for consumption, keep it with you. 20,000 rupees you don't keep idle, you invest. When you will invest 20,000, what will happen? This opportunity cost, what you are bearing here when you are keeping the money idle, this will be 0. Yes or no? That is what Baumol was trying to say. That don't keep idle money with you. What you should do? Keep money in a combination of cash and investment, so that your opportunity cost could be minimized or it could be 0. Sir, why Baumol said minimize? Some people might say that okay, I may need 80,000 rupees for consumption, but 10,000 rupees I want to keep in cash with me just to be cash ready, to reduce the risk of inconvenience. I should have cash with me like that. I should have cash with me like that. Correct? It means out of 20,000, 10,000 rupees they want to keep in cash with them. And the balance 10,000 when they will invest, it means how much money how much return they will accrue? 10,000 ka 10%. They will earn 10,000 rupees, sorry, 1,000 rupees ka return. In that case, what will be their opportunity cost? 1,000. It means their opportunity cost could be 2,000, but just because they decided to invest some part of their idle money, their opportunity cost minimized. Yes or no?
Yes, sir.
That is the theory of Baumol. That is what this point is saying, that we should have cash, money and interest bearing assets also. Do we understand this thing, guys?
Yes.
Sure?
Yes, sir.
Any doubts? Any question? Sure? Eh? How much money you will hold? It depends upon what? It depends upon your income, and also it depends upon the brokerage you have to pay to buy the asset. Sir, what do you mean by this? अब देखिए, if your income is more, you will hold more cash, yes or no?
Yes, sir.
If your income is less, you will hold less cash. It means there is a direct relationship, yes or no?
Yes, sir.
Inverse relationship? Direct. Correct?
Yes, sir.
Second says, it is directly related to the brokerage also. How much commission you have to pay to buy the asset. अब देखिए, if you have to pay high commission to buy the asset, what will you do? You will refrain yourself to buy the asset. You will not buy the asset. What will you say, sir? Why I should pay unnecessary money on the commission?
Yes, sir.
It means you will not invest your money. You will not invest your money. But what will you do?
Save.
You will keep money in cash. Yes or no?
Yes, sir.
Yes or no?
Yes, sir.
Direct relationship. If the commission is less, what will you do? I have to pay less commission. Let me buy the asset. I will earn return. And whenever I need money, I will sell the asset. I will get my money back. It means when there is a less commission, you will use less cash with yourself so that you can buy more assets. Clear? Eh? People, yes.
Yes, sir.
This is the direct relationship. Indirect relationship with carrying cost, that is the interest income sacrificed to hold money. If rate of return is less, will you invest money or will you keep money with yourself?
Keep money with yourself.
It means when rate of return is less, you will keep more cash with you. And when rate of return is more, you will keep less cash with you. Yes or no?
Yes, sir.
Indirect relationship. Yes?
Yes, sir.
You leave this particular point. This point you leave it up for now. Okay? Just study this for a point only. Is it okay for you?
Yes, sir.
Sure?
Yes, sir.
Now, when we say that it is always good to hold money in cash and asset together, which will reduce the opportunity cost, Baumol proved this thing by giving this equation that is also known as square root rule. C equals to under root 2by upon R, where this means that the average amount of cash withdrawal which minimizes cost is the square root of the 2 times broker's fees. It means B here is the brokerage, C is how much money you should keep in cash, that is cash withdrawal, multiplied by the size of an individual's income. Y is the income of the individual, and divided by the interest rate. So R here is the interest rate. Okay, so how much money you should keep in cash, how will you find it out? By this square root rule. Are we clear? MB equals to PT, first equation. MB plus M dash B dash equals to PT, second equation. Third equation, LR equals to KY. Fourth equation, C equals to under root 2BY upon R. Clear hai? That is the inventory approach to transaction balances. Okay, so the next theory we'll do is, again, it is the post-Keynesian development in the theory of demand for money. It is the demand for money as behavior toward risk. Before I start this theory, you should know that there are 2 types of people in the economy. First is risk taker and the second is risk averse. There's a third category also, which is risk neutral. Risk taker means they love taking risks. They can take risk. Risk averse means the people who avoid taking risk. And risk neutral means they are on a neutral side. They may not take risk. Okay, remember this thing. This theory will be easy for you. First is given by Tobin. Same, given by Tobin in his article Liquidity Preferences as Behavior Towards Risk, 1958. It says, according to Tobin, an individual would hold an optimally structured wealth portfolio is comprised of both bonds and money. The same thing I explained you before. That we hold money, the same theory hai na? We hold money both in cash and the securities, the investment, correct? It says bonds will provide you return, money will give no return, but there is also no risk. In bonds, in investment, it gives returns, but there is a risk. In money, there is no return, but there is also no risk. So risk of what? Risk of, losing the money. It says the rational behavior of a risk-averse or risk-hater economic agent induces him to hold an optimally structured wealth portfolio which comprises of both bond and money. A person who is ready to take risk, right? Generally, it is seen that a risk-hater will take less investment and will keep more cash so that he can avoid the risk. But the person who is ready to take the risk, he will take an optimal structure where he will do the investment also, he will take a risk which will get him return, and he will keep cash also. Are you clear? Yes or no?
Yes, sir.
Do we understand this thing? This is what is the demand for money. This is what is the demand for money as behavior towards risk. This particular theory simply says that if a person is a risk hater, he will keep only cash with him, and if a person is risk taker, then he will take a good risk where he will try to make a combination of the inventory where he will keep cash also, and he will invest his money in the securities also, so that he can generate return with a minimal risk. Are we clear? Yes or no?
Yes.
There is one more point to be understood here. Sometimes risk averse person, risk hater person, sometimes what he will do, he will also keep a optimal structure of cash and inventory. Of that optimal structure will be in such a way that the assets he is buying, assets will be less, so that he earns a bit of return, and he will put his opportunity cost to the minimum point. Means I am a risk averse person, I cannot buy only inventory, that will be too much of risk. I will take cash also with me, I will take some of securities so that I can earn a very little passive income, and my risk also will be very less. This is also one of the point of view of the stopping theory. Are you clear with this thing? Right? This is the theory of demand for money as behavior towards risk. Done? Okay guys, the next concept we are going to understand is the liquidity trap. Now, what is this liquidity trap? Liquidity trap is a situation, is a hypothetical situation where we have to understand that we might fall into a trap, we might fall into a situation where we see that there is no liquidity in the market. Means people are not ready to invest, money is not there in the market, money is not flowing in the market. Okay, that is situation is what we call liquidity trap. Are we clear? Now sir, what will happen that money will stop flowing in the market? मीन्स ऐसा क्या होगा कि मार्केट में पैसा ही आना बंद हो जाए? What will happen that market will stop flowing in the market? It's a very simple thing. If I have 1 lakh rupees with me, when will I invest my money in the market? It is only when I think that my money will generate some return. So for example, let us say I have 1 lakh rupees in my pocket. Okay. Now, there are two ways I can use this money. We have discussed this thing before also. I can keep this money with me idle in my pocket, or I can invest my money. Let us say if I invest my money, the return I'm getting is 10%. Clear? Hai? Now, it means if I keep this money idle with me, that is 1 lakh rupees, it means I am losing interest or I am losing return of 10,000. Yes or no?
Yes, sir.
It means this is my opportunity cost of holding the money idle. Yes or no, people?
Yes, sir.
Correct? Now, if this rate of return increases from 10 to 25%, from 10 to 25%, what do you think? What will I do? I will hold my money or I will invest my money?
Invest.
Reason being, because my opportunity cost is increasing. Clear? Hai? Although you are giving your money to the market, it is a risk. You are giving your money to the market, it is a risk. But you know that the risk is worth taking. Why? Because you are taking the risk and you are getting a reward also. Yes or no? Do we understand this thing? People, yes or no?
Yes.
Okay. Tell me one thing. If I reverse this situation, and what if I say that the rate of return is 0%. Will you take the risk will you take the risk to invest this money in the market? Yes or no? No, of course no. Now, when you will not put your money in the market, if you don't put your money in the market, tell me one thing, will that money be used to give loans to someone? Will that money be used to put into the bank and bank will be able to use that money? Yes or no? It means if you are not putting your money in the market, it means money will stop flowing in the market. Yes or no? It means velocity of money will be zero. mv equal to pt v, velocity will be zero. अब if money stops flowing, ultimately what will happen? Our economy will stop working. Our economy will come to an halt. This situation where because of very low interest rate, because of 0% interest rate, when the economy stops working because money is not flowing in the market, this situation is what we call liquidity trap. We are into a trap. We are into a situation where we cannot overcome. Why? To overcome the situation, we should have money with us. We need money to do the activities. And if we don't have the money to do the activities, we will be stuck. Yes or no? Are you clear? So this situation where we cannot move because our economy has come to an halt because of the low liquidity in the market. That is what we call liquidity trap. Do we understand this part? Sure? Let us now read it. It says, liquidity trap is a situation when expansionary monetary policy, that is the increase in money supply, does not increase the interest rate. Means market money supply is increasing. Money supply is increasing, but it is not affecting the rate of interest. It is neither increasing nor decreasing. ROI is not being affected. Are we clear? And hence does not stimulate economic growth. Up we are increasing money supply, we are putting money in the market, but that money is not generating returns. Means the investment is not generating the returns we were expecting. It means what will happen? Our growth will not stimulate. It means our growth will come to an end. It will stop. Yes or no? Liquidity trap is the extreme effect of monetary policy. It is the extreme effect. I mean, this will be like when everything will come to an end. That is the extreme corner of the monetary supply. Although the authorities will never allow monetary supply to behave this way. Sorry, monetary policy to behave this way. Although the authorities will control all the things before the economy falls into the liquidity trap. But it is very much important for us to understand that this could happen. This is a possible situation. Are we clear? It is a situation in which the general public is prepared to hold on to whatever amount of money is supplied at a given rate of interest. They do so because of the fear of adverse events like deflation, war, etc. Means I have money in my pocket, but I'm holding that money with me. Why? Because I am anticipating, I am thinking, according to me, the market might not behave in a good way. Yes or no? Just because it is my anticipation that market might not behave in a good way, in that case, what is happening? In that case, a monetary policy carried out through open market operations has no effect on either the interest rate or the level of income. When the supply of the money which was flowing and all of a sudden it will be cut off. In that case, whatever money we have in the pool, we will not be able to generate good returns from it, which will attract the people to invest more and more money. Are you trying to understand? Yes or no? Do you understand this part? Yes? देखो दोबारा करते हैं. We'll do it once again. What I'm saying is, it is about the mindset. It is about the mindset. What if I say that there is a company which is going very well, the company is performing very well, but because of some actions of the company, people are now losing their interest in that company. Like, for example, stock market. अब in stock market में what happens? Whenever a company will issue its shares for the very first time, whenever a company will come up with its IPO, initial public offer. Now, people might think that this company ka IPO might give some initial part per return. So what they did, they keep on supplying the money. And after opening of IPO, the moment IPO gets listed, the moment the price of the share is revealed, people saw that we invested at 10 rupees per unit and now the price is 20 rupees per unit. What people will do? People will take out their money. Yes or no? अब देखिए, initially the company grew, but people thought that this is the maximum growth and my money will not grow further. What they did? They took out the money. It means what? The growth of the company got stuck. Wait, when company is not having the money now, how the company will continue the growth? Yes or no? It means it is the anticipation of the people, what they think. Correct? Here also it is happening the same thing. It says if people are losing their interest because of the fear of adverse events, it is just the fear. It is not happening. It is saying that if people they fear that now too much of growth we have seen, but now there is a possibility that economy might go down. We might see deflation. We might see micro में पढ़ा ना factor affecting demand, future expectation about the price. Whenever we expect price to decrease, what do? We control our demand. Yes or no? Correct, है ना? That is what is happening. At the moment, people they are very much scared that now they might see that there is no return coming in, or they might see a very adverse effect on their investment. They will take out their money, or they will hold their money. Yes or no? When they will take out the money, or when they will hold the money, tell me, can we continue this growth? We will be able to continue this growth? Yes or no? Yes or no? Economic indicators. Economic indicators means there are many elements, there are many indications that might lead you to think that this may happen. Pakistan preparing with war with India, China preparing for war with India. Now you might think, there might be a war condition here. In that case, India might lose the resources and the prices might come down. Yes or no? Yes or no?
Yes, sir.
Weather is not good. Let me take an umbrella with me while going outside. That is your thinking. Why? Because indication aa raha hai that weather is not good. It might rain. Yes or no? Are you getting a point? So how can you control the thinking? Anyways, are we clear with this thing? Yes.
Yes, sir.
Second is, in a liquidity trap, the monetary policy is powerless to affect the interest rate. When an economy comes into a liquidity trap, you do whatever you want to do. Economy will not generate the returns. Why? Because the mindset of people is very wrong right now. People are not ready to invest more. People are willing to take out their investment. Yes or no? Abhi currently the stock market is very down. Now, to make the stock market grow, what do you think? What is required? More money is required, or we should take out the money from the stock market? If we start taking out the money from the stock market, or if we cut down the supply of more money in the stock market, do you really think that this market can recover? Yes or no? Yes or no? That is what they are saying. If our mindset is going adverse and we stop the money supply, or we try to take out the money invested, what will happen? Our economy will continue falling. Do you understand this point? Yes or no? There is a liquidity trap at the short term 0% interest rate. क्या बोला था आपको मैंने? If the rate of interest, if the interest rate is 0%, it means there is no good reason for me to invest my money in the market. Why? It will be like my money in the hand of the market at the risk where I know that my return will be zero. Will you do it? Nobody will do it. Are we clear? When interest rate is zero, public would not want to hold any bond. Obviously, when interest rate is zero, people will not like to hold any bond. But why I should give my money to company when company is not giving me any return? I should keep my money with me. At least I will feel safe that my money is with me only. Yes or no? Do we understand this thing? Since money which also pays 0% interest has the advantage of being usable in the transactions. With you also the money will not earn any interest. When you keep money idle with you, it will not earn any interest, I understand. And anyways, in the economy, what is the interest rate? Zero. It means here also no return, here also no return. But for you, where will you feel safe? Your money, zero interest with you, or your money, zero interest with someone else? Your money with you, 0%. Yes or no? But this is not a good thinking. This is the adverse thinking. What people are thinking that we are not able to generate the interest, so let us keep our money with me. But they forget that companies to generate return, they need money with them. Then only they will use this money and then they will work and they will generate return out of it. It means patience is the key. If the interest rate goes down, like now, if the stock market is down, don't pull out your money. You stay calm, because in long run it will recover on its own. This money will be utilized in a good manner. Are we clear with this thing? Do we understand this thing, guys? Sure? Any doubts from this slide? Any doubts? Read the language and come up with the doubts. If you have any, go with it. It means if I keep the money with the company, that money will be used. But we are not keeping money with the company. Why? Because we know that risk is high and return is zero. And because of this reason, we continue to be in the liquidity trap.
The concept that we have to put our money with the company at a zero level of interest.
It is about, see, yes, of course, yes. That is the key. When you trusted the company and you gave your money to the company, you should not forget that first initial point where you invested in the company because you had trust on it. Acha, I am not saying that this trust cannot change. It can change, but you have to be positive. This will happen when the people will go negative. When they have in their mind that nothing can happen now, nothing can save us, then this will happen. That is the reason we are clearly mentioning that it is the extreme effect. It is the extreme effect. It is the extreme effect. It is not the regular effect. It is the extreme effect. When everything will go wrong, when everything will be like people will go negative, then this will happen. Are you clear with the language, guys?
When the stock market fails, then then it is a good opportunity for investor.
Yes,
to
of course.
invest the money.
Yes.
Because in future maybe the return is more.
This is what we call positive approach. I'm talking about this thing only. Now when stock market is down, what many people are thinking, we will lose our money, let us just pull out our money. But this is a golden chance to invest more and build our portfolio. This will happen when people will not think this way. When people will think that it is falling, it will keep on falling. No, it cannot happen. Everything will recover in the long run. It cannot happen like that. That is what they are saying. When people go negative, then this is the extreme situation they can expect. Understood? Because the market is not moving that way. It could be because of n number of reasons. We don't have opportunities. We are not able to do the productive activities. We are not able to anticipate what is to be done, what is not to be done. anything could lead to zero interest, and this is the extreme situation. I'm not saying that it will happen in general things. No. It will be like extreme things when everything is going adverse and adverse and adverse. At the end, the result will be zero interest rate. It is only an assumption. It is the extreme case we have taken. Maximum it will happen. हाँ नहीं इंडिया का पूछ रहे हो ना इंडिया में नहीं हुआ अभी तक इंडिया में इज लाइक इंडिया हैज बीन इनटू अ सिचुएशन वेयर इंडिया is into a debt trap, not the liquidity trap. Debt trap में रही है. Debt trap as in one loan we have taken from World Bank. We didn't have the good opportunities to earn more money. We could not repay. We have to take another loan to repay the first loan. Another loan to repay the second loan. This has happened. This has happened. Sorry? वहां पर एक बारी I really don't know about the situation what you're talking about, but if it has happened, yes, it might fall into this concept. That is what he is saying. It could be the situation. I have to see what is the situation you are talking about.
So can we say only this this is happened only when the inflation or when the war situation like this?
This will happen when the market is not capable of generating return because of any reason. It could be war, it could be post-war reconstruction, it could be anything. Because are we clear with the things? Shall we move in? Take it. In other words, understand this part please. In other words, investors would maintain cash savings rather than hold bonds. The speculative demand becomes perfectly elastic. What is perfectly elastic? A very small change in price or no change in price will decrease your demand to the dramatic level. Are you clear? So, the speculative demand becomes perfectly elastic with respect to interest rate, and the speculative money demand curves become parallel to the x-axis. This situation is called a liquidity trap. It means your demand for investment is decreasing, and there will be a point where it will become perfectly elastic. This part where your demand curve will be flat, parallel to the x-axis, this will be known as perfectly elastic demand. That is what we're talking about. So this part will be known as liquidity trap. And try and understand, we are talking about perfectly elastic demand where in terms of interest rate. It means when interest rate will go zero or it will dip to the very minimum level where people are not ready to invest, that will become perfectly elastic. Are you clear?
Yes, sir.
Yes or no? What to do? If liquidity trap happens, then what to do? In such a situation, the monetary authority is unable to stimulate the economy with monetary policy. It means our policies are not working, our plans are not working. Whatever attempts we are making, they are not generating returns. It means we cannot correct the situation using the monetary policy. Why? Because we went into liquidity trap because of the failure of monetary policy. Monetary policy has failed. That is the reason we have went into the liquidity trap. It means there is no way that we can correct the situation using monetary policy. Now what to do? Since the opportunity cost of holding money is zero, even if the monetary authority increases money supply to stimulate the economy, people would prefer to hold money. Means rate of interest is zero now. If government tries to push money from its own pocket in the market, what will happen? For some time, the market might move a bit. But to keep it in a motion, we need regular money supply. And who can give that? Households and firms can give that. And they are not ready to do that. Why? Because the rate of return is zero. It means if government pushes the money supply in the market, that will also not help anyone. Are you clear? Consequently, excess funds may not be converted into new investment. It means whatever new funds government has put in the market, that will not be converted into good investment. Why? For some time they might be turned into investment, but to keep it going we need constant money supply, and that is not happening. It means if government puts in the money supply, that will be a waste of money and time. Yes or no? Yes or no? The liquidity trap is a synonymous with ineffective monetary policy. So liquidity trap is a result of what? It is a result of failure of monetary policy. That is the reason. Ab you see what would be the maximum effect of the monetary policy. That is the reason when we talk about the two most important policies of India, one of them is monetary policy and second is fiscal policy. Monetary policy is so important that it may cause this situation. That is the reason it is drafted very carefully, so that in the extreme and extremist situation also it should not fail. Are we clear with this thing? Yes or no?
Yes, sir.
Sir,
Yes.
in case of failure of monetary policy, what should do if we are depositing bank money, sir?
We have to, in case of liquidity trap, we have to attract the households. In case of liquidity trap, we have to disseminate the knowledge to them. We have to tell them that this is the thing. If we continue doing like this, we will never be able to recover. So you should invest money and wait for the returns. Wait for the long term returns. In short term, you might not get the returns, but in long term, 100% you will get the returns. Sir, what is the surety? I'll show you one example. Hopefully, you will understand it. Chapter number 4, Microeconomics, Market. In market, if you remember, in short term, in monopolistic market, you may see supernormal profit. You may see normal profit. You may also see loss. But because of free entry and free exit, what will happen? In the long term, there will be only and only normal profit. It means what? Short-term situation might be adverse, but long-term situation will never be adverse. Do you get my point? Yes or no? This is what we have to teach people. And beta, this is why we are studying economics. So that we should understand that whenever we put the money in the market, our view should be long-term view. Because in short term, now also, no, stock market is very down. Ab who knows tomorrow or after 1 week or after 1 month or after 1 year, the stock market is increasing at a high pace where the investments are being doubled. Who knows? In the long term, anything could happen. Yes or no? Are yes or no, people? Sure. Any person who has invested money in Wipro like company 15 years before, let's say he might have invested 1 lakh rupees. What do you think? His investment has not seen a decline. His investment might have seen a decline. But today when you see in the long run, right, his graph might be like this. Constant dip, increase, dip, increase, dip. But in long term, you see after 15 years what is happening. His 1 lakh rupees has become 100 crore rupees. In long term, I am saying. That is what we have to showcase the people. Are you clear? Are we clear with this thing, everyone?